the American middle class is quietly splitting into two groups. One group is watching their net worth hit record highs, while the other is staring at the price of groceries, wondering how things got so expensive. If you're a beginner starting to invest, you're likely feeling paralyzed in the middle. The stock market looks incredibly high, so you're keeping your capital in a savings account, waiting for a major crash before you make a move. This chart shows exactly why that wait-and-see strategy is failing. While top-line stock prices are climbing, the currency sitting untouched in your bank account is losing value faster than the official inflation numbers indicate. In a high-inflation environment, the correction you are waiting for rarely happens on the stock chart. Prices often stay exactly the same, but your dollar's purchasing power crashes right out from under it. Holding cash guarantees a silent, systemic loss of your buying power. In 2026, playing it safe is actually the most dangerous financial move you can make. The Federal Reserve has made their position clear. The era of 0% interest is dead. We are now dealing with sticky inflation and mortgage rates locked firmly around 6.5%. These factors have structurally shifted the baseline cost of living in the United States. We are not looking at temporary price spikes that will eventually cool off. This K-shaped graphic illustrates the finalized economic structure we have to navigate. The economy is pulling violently in two different directions. Individuals who own assets are watching their net worth climb directly with the market. Individuals relying strictly on earning a paycheck are absorbing the full weight of the inflation tax. For a beginner today, the goal isn't simply to generate returns. Your primary objective is to outpace a currency that is continuously devaluing. Look at this 4-quadrant matrix to evaluate options for an initial $1,000 portfolio. The first strategy is the cash sideline. You keep your money in a traditional savings account. Your balance stays perfectly stable, but the trade-off is guaranteed decay from inflation. You avoid the daily stress of market volatility, but your money buys less housing and fewer groceries every single month. To combat that decay, we pivot to active investments. That brings us to strategy 2, the index anchor. You allocate 50% of your portfolio to broad U.S. market index funds. This allows you to capture the overall productivity gains of American corporations. The trade-off is you must accept slower growth and endure broad market dips, rather than seeing rapid overnight gains of a single tech stock. Broad market exposure represents the collective survival of the best American companies. It serves as the mandatory safety net for the rest of your portfolio. Moving into growth, the nature of technology investments has evolved. We've moved away from the basic chatbot AI of 2023 and into agentic AI, software that executes actual corporate workflows. The companies manufacturing this hardware power massive AI factories that run entire supply chains. They sell the shovels for the modern gold rush.
This introduces the third quadrant, the infrastructure play. This strategy gives you direct exposure to a massive business-to-business spending boom. You're buying into industrial suppliers securing massive gross margins. The downside is extreme sector-specific price volatility and incredibly high entry valuations compared to broad indexes. Wealthy investors are handling this by avoiding legacy tech laggards burning through cash. They pivot strictly to energy providers and hardware suppliers powering data centers. In this economic era, you are either an owner of the machines and the data infrastructure, or you are paying rent to the owners. Underneath all of these options sits the problem of government spending. The U.S. national debt is expanding at a staggering pace. Massive amounts of liquidity are constantly being injected into the system just to keep the government functioning, which directly drives inflation. To combat this, we evaluate the final quadrant, the scarcity hedge. You dollar-cost average 5 to 10% of your portfolio into a hard asset like Bitcoin. It acts as a long-term insurance policy against fiat currency devaluation. The trade-off requires heavy emotional discipline. You have to be prepared to endure massive short-term price drawdowns without panic selling. Holding a hard asset provides a structural defense against systemic currency devaluation. Let's pull these strategies out of theory and into execution. Here is exactly how a pragmatic beginner should allocate their first $1,000. This decision tree maps out the logic. Your first decision is priority. Do you require absolute safety from market volatility? If yes, you stay in cash and you accept the guaranteed decay of your purchasing power.
If no, and you are willing to accept volatility to beat inflation, your split looks like this: 50% into the S&P 500, 40% into high-margin infrastructure, and 10% into hard assets. When picking individual companies for that infrastructure bucket, there is one major risk you must screen for: zombie debt. High interest rates mean companies with more debt than cash are destined for bankruptcy. They cannot pay their interest without borrowing more. Clean balance sheets are a mandatory requirement. Real cash flow is the primary metric. If a company cannot generate a profit today, it is a liability, not an investment. This blueprint is for the pragmatic beginner willing to systematically buy in, even when the broader market is sitting at all-time highs. It is not for hype chasers trying to buy lagging tech companies, and it is not for individuals trying to time the absolute bottom of a nominal crash. The modern economy does not reward the patient, it rewards the positioned. Remaining on the sidelines is costly. You need to secure debt-free assets to protect your wealth. We track the Fed and the markets every week, so you don't have to. Hit the subscribe button and let me know in the comments, are you buying the infrastructure dip, or are you still holding cash waiting for a drop? See you in the next one.